In this video, we're talking about the federal government's war on small to medium-sized enterprise in this country and new anti-capitalistic confiscatory tax measures and what you can do about it to protect yourself and your business. Stick around to the end and I'll show you a number of strategies to counteract these tax measures. Hey, it's Ross Deep and welcome to The Deep Edge, where we discuss strategic wealth management for business owners, executives, and incorporated professionals. One of the things I want to do here is to help you take responsibility and take control of your financial legacy, tax, trust, and estate situation, and give you a strategic layer between you and your professional advisors. We're going to try to get you the real deal on a number of issues, including various corporate structures, the big pictures on personal strategic wealth management and corporate structuring, strategic rationale, and the value proposition associated with some of these strategies and various combinations. We want to act as kind of an antidote to you having to figure this all out on your own. And if you like what you see here, please make sure you click on the subscribe button and notification bell below. Small to medium-sized business owners and incorporated professionals are under attack on many fronts in Canada. Financial, taxation, legal, regulatory, environmental compliance from government and anti-capitalist groups. Whether it's a pandemic lockdown or health arrest, you name it. It feels as though there's been sort of a shadow war on small to medium-sized business in Canada, whether by covert or overt means. The result has been no less than an assault on your freedom, independence, and financial legacy. But don't worry, it's for your own good. The budget will balance itself, and there will be growth in the spring. For that one. It really seems to be open warfare on independence and success. A recent salvo by the federal government was the 2018 budget. Changes to the passive income taxation rules for Canadian-controlled private corporations introduced a punitive tax measure which amounts to confiscatory taxation. The main points of the attack were punitive changes to the passive income rules and income splitting. In the run-up to the budget, Ottawa's anti-capitalistic bias was totally exposed when they branded business owners as tax cheats for just following the rules. The whole thing started in 2004 when doctors in this country were looking for a pay raise. And the Ontario government said that instead of increases, we'll allow you to incorporate and use that as a tax shelter, which brought everything in line with the rest of Canada in Ontario. So they allowed funds to remain in the professional corporations so they could save in a tax-free environment for retirement and future capex. And this naturally led to passive income within the corporation. Now, years later, the federal government has broken the deal. Ottawa took a look at the funds sitting in these corporations and various structures and decided they wanted to tax those funds and circulate them back into the economy. So they said, you can take these funds out either as T4 earnings, dividends, or bonus it out to yourself, however you want, but you're going to be paying approximately the same high rate amount of confiscatory tax based on integration. Or you could leave it sitting in your corporation and potentially lose some or all of your small business deduction and pay even higher tax. This is the concept of integration, which effectively means that whether you take T4 income, dividends, or bonus the funds out to yourself in earnings, you will pay approximately the same amount of tax. On top of this, Ottawa has shut down income sprinkling, or paying a salary or dividends to family members. Under the new tax on split income rules, family members that are not active in your business will be taxed at a top marginal tax rate on dividend payments. They are limiting alternatives and forcing you to make a decision. So there's a need for planning in order to be able to address this. You want to look at alternative vehicles beyond the standard RSP, spousal RSP, TSFA, or RESPs in order to protect your corporate wealth. Part of the problem is that accountants are often primarily focused on the now occupied with immediate corporate and personal tax savings, preparing financial statements and tax returns, and unable to do very much in the way of corporate tax planning. That is proactive. So you're likely too busy running your business to take care of this yourself as well. So you're going to have to take a look at various strategies. You're faced with a challenge. You can pay these funds out to yourself and pay a lot of tax, or you can leave them in your corporation and pay even more tax. You're being forced to do something or lose this equity. So what do you do to protect yourself? Well, proper planning and corporate structuring is needed to address this. There are a number of main strategies that can be used to address this type of situation that end up deferring and saving you a meaningful amount of tax, so you don't end up giving away all your sweat equity and family wealth. The first strategy you want to have a look at is the individual pension plan, otherwise known as the IPP, which is a basic core strategy to build upon, and it'll help defer and save tax. Now, IPPs are a defined benefit pension plan that are registered with the government and set up residing within your corporation. It's like the Ontario Teachers Pension Plan for business owners and incorporated professionals, including doctors, lawyers, dentists, and accountants. The IPP resides within the corporation and allows you to put away significantly more for retirement than an RRSP on a tax-deferred basis. A major bonus is that extended past service may allow you to contribute a large initial amount of funds to the plan. These funds are managed or invested in a number of possible vehicles within your plan. So, this strategy has now become a main go-to vehicle for tax-deferred savings within your corporation and something to build upon. An IPP would address the passive income situation and is great if you want tax deferral as well as a forced discipline of putting funds away for retirement and a guaranteed outcome of regular monthly payments after you retire. The IPP is a good place to start and can be used as a standalone strategy or in combination with a number of others. Other strategies you want to have a look at are the use of corporate-owned life insurance, or COLI. Another possibility, it is a retirement compensation arrangement. Corporate-owned life insurance is one of the last remaining tax shelters available in Canada. It has the benefit of both risk management and tax-deferred investment. Allows you to grow your corporate wealth in a tax-free environment within the corporation in the policy, and you can access that capital later on and pass it to your heirs. So you might want to look at corporate-owned life insurance as a savings and investment vehicle, which allows you to defer the tax as long as you have an insurance need. And since you're not likely going to be spending these funds, you might as well save them in a tax-exempt insurance vehicle within your corporation and allow it to grow on a tax-free basis. Once a policy has accumulated significant cash values, it can be assigned as collateral for a third-party line of credit and paid out to shareholders. And remaining balances may eventually be paid out as a tax-free benefit through your capital dividend account. Third possibility to look at as a strategy is a retirement compensation arrangement. For higher earning business owners and professionals, an RCA might be worthwhile having a look at to implement significant tax savings and facilitate a buyout or succession plan. And I'll cover RCAs in more depth in a future video. So I'd like to emphasize that they're forcing you to make a decision. You want to seek out professional advice on proper, prudent corporate structuring, tax, trust, and estate planning. Thanks for watching, and don't forget to click the subscribe button and notification bell below.